So what's up, everyone? So in this presentation, I'm going to talk about ETFs versus index funds, right? And the differences between the two and which one is best for you. So I'm an instructor. I have a bachelor's in business. I'm also a continued education and finance instructor. I'm also an Amazon bestselling author, and I'm also a multiplex investor. So I wasn't able to get into real estate. First, for those who want to know what a multiplex is, that's a multi-unit. So I wasn't able to get into real estate without investing in stocks. I invested in a portfolio, then I borrowed from that portfolio and I bought my first property. The first property I got was a multi-unit, 5 unit, 4 apartments, and a commercial space on the ground floor. My next property I invested in was a single property that I converted into a 2 unit. Then I opened a recovery home slash halfway house. So I wasn't able to do that without stocks. So when people ask which one is the best investment, stocks or real estate, I say have a combination of both. So now let's get into this. I'm going to be reading from a PowerPoint slide, so please bear with me. All right, so what is an ETF? An ETF is an exchange traded fund, a type of security that involves a collection of securities such as stocks that are often tracked an underlying index. Although they can invest in any number of industry sectors, ETFs are in many ways similar to mutual funds. However, they are listed on exchanges, and ETF shares trade throughout the day just like an ordinary stock. ETFs can contain many types of investment, including stocks, commodities, bonds, or mixture investment types. An exchange traded fund is a marketable security, meaning it has an associated price that allows it to be easily bought and sold. All right, I'm gonna get into more of that so you'll understand it a little better. What is an index fund? And you hear many YouTubers talking about index funds. You see a lot of people talking about the FIRE movement, right? How they have invested in index funds and were able to retire. Um, So, index funds. An index fund is a mutual fund or exchange traded fund ETF designed to follow certain preset rules so that the fund can track a specified basket of underlying investments. Another way of explaining it is an index fund is a portfolio of stocks or bonds designed to mimic the composition and performance of a financial market. Index funds have lower expenses and fees that can be actively managed and by actively managed funds. Index funds follow a passive investment strategy. Um, Now there are 5 types of ETFs. Remember, I said there are there are 5 types that make up ETFs of bonds. All right, so you have a bond, right? ETFs might include government bonds, right? So corporate bonds and state and local bonds called municipal bonds. Then the next ETF, the industry type ETF, which track particular industries such as technology, banking, or oil or gas. And that's a common one a lot of people like to invest in is technology. A lot of the people talk about they've gotten rich through investments. Usually technology or medical are high on the list. The next type of ETF, the third, is a commodity. Invest in commodities, including crude oil or gold. Currency is the next type of ETF. Invest in foreign currencies such as euro or Canadian dollar. I don't know where cryptocurrency falls in on this. Maybe I'll learn more about that. I still today have not invested in cryptocurrency. I still don't have enough confidence in it yet. Even though you have people like Dr. Boyce Watkins who advocated investing in cryptocurrency, me personally, I'm not that savvy with it to have the confidence to tell someone else to do it. And inverse, the fifth type, attempt to earn gains from stock declines by shorting stocks, shortening and selling a stock, expecting a decline in value, and repurchasing it at a lower price. Now, we hear about this all the time. So there are 5 types. I named them 5 types of ETFs: bonds, industry, commodity, currency, and inverse. Okay, so what ETFs and index funds have in common? This is the 3 things that they have in common. Diversification. Just having a few index funds or ETFs can lead to a very diversified portfolio. For example, an ETF based on the S&P 500 will give you exposure to hundreds of the country's largest companies. They're low cost investments and strong long-term returns. So those are the 3 things: diversification. So they allow you to invest in different commodities, if you want to call it, right? And give you exposure to some of the country's largest companies. So you can basically have stock in Walmart, Target, Bank of America, right? And also low cost. So you don't have to come in with a lot of money to get into purchasing an ETF or index fund, and they have strong long-term returns. So the best thing about that is you're not going to get rich right away with that. It's a real buy and hold strategy when it comes to investing in these types of funds or stocks. All right, the differences between ETFs and funds, the way they're bought and sold. The biggest difference between ETFs and index funds is that ETFs can be traded throughout the day like stocks, whereas index funds can be bought and sold only for the price at the end of the trading day. Minimum investment required. In many cases, ETFs will have a lower minimum investment than index funds. Most of them, all it takes to invest in an ETF is the amount needed to buy a single share. And some brokers, such as Robinhood, even offer fractional shares. So, for instance, some companies require you to purchase a limited amount of shares. Some of them want you to purchase 200 shares, right? So, but an ETF allows you to purchase maybe just a single share in a company, right? For index funds, however, brokers often put minimum prices in place. Could be quite higher than a typical share. Vanguard, for example, has a minimum investment of $3,000 for most of its index funds, right? So it's cheaper if you want to get into ETFs than if you want to get into index funds. It's cheaper to get into. Right, next, the third thing that they differ, the capital gains taxes you pay. ETFs are more tax efficient than index funds by nature, thanks to the way they're structured. When you sell an ETF, you're typically selling it to another investor who's buying it, and the cash is coming directly from them. Capital gains taxes on that sale are yours and yours alone to pay. To get cash out of an index fund, you technically must redeem it from the fund manager. You will then have to sell the securities to generate the cash to pay you. When this sale is for a gain, the net gains are passed on to every investor with shares in the fund, meaning you could owe capital gain taxes without ever selling a single share. So that's why I say, if you ask me, I would prefer to go with ETF if you're new to investing and you don't understand this that much. Stick with ETFs. They're easy to manage. You could pick which commodity you want to go within that, or which one of the 5 types I mentioned, bonds, whatever. You can pick it, and it's easier for you to track, right? Index funds require more. Okay, and differences continue. The cost of owning them, which is kind of like what I just talked about, the cost of investment and the cost of owning them, right? So the cost of investing, of course, we know that the ETF is easier to buy. Index funds are a bit more complicated and require more money down, right? So both ETFs and index funds can be cheap to own from an expense ratio perspective. For example, Schwab's broad market ETF and Vanguard's S&P 500 ETF both have expense ratios of 0.3%. As if the writing, meaning you'll pay just 30 cents per year for every $1,000 invested. Schwab's S&P 500 index also has an extremely low expense ratio, 0.2%, while Vanguard's total stock market index funds and Merrill shares has an expense ratio of 0.4%. So the cost of owning them basically by the percentage. There isn't that much difference between the two as far as the cost of owning them. It sounds like index funds are just a little bit higher, but not that much. Maybe by 2%, 1 to 2% more. The 3 S&P 500 ETFs. Um, so you have a SPY ETF, IVV, and there's OO. The VOO, which is number 2, which I didn't put here. VOO is number 2. Okay, so when it comes to yield of return, according to figures from the Morningstar, the IVV currently has the highest 12-month yield income generated from interest and dividends. But VOO currently has the highest 5-year price return, the financial gain on the investment, and the lowest management fees. Okay, so let's Okay, so these are the brokers that I would recommend to you if you want to get into this right away. Let's say right now you can turn around to your computer or your cell phone and you can open up an account with any one of these and start trading right away. Start investing in index funds and ETFs. Fidelity Investments, commission-free stock ETF and options trade. That's the one I have. I have Fidelity. I have an account with them. Then you have Charles Schwab, right? Zero online stock ETF and options commission. That's Schwab. Then you have E-Trade, which I think a lot of people know E-Trade. They tend to advertise more. Get $600 or more when you open a fund, a new account at E-Trade. So it sounds like they have more perks to sign up with them. But I can't say which one is better. All I can say is which one works for me. I love Fidelity Investments. If you log into your profile, you can actually track you can track your investments, and they really have it separated in the form of pie charts so you can really understand how your investments are working. And 5 ways to get rich from investing in stocks. For those of you that would like to know how to get rich, there are 5 ways people get rich from stocks, right? One is budgeting for investing. So um, you should know exactly how much you have to invest up front, right, for the long game. Two is index funds and ETFs, which I mentioned, right? You can get rich through those through buy and hold. Number three, buy and hold, same thing, but that doesn't have to be limited to index and ETFs. Stocks, the purpose of stocks, investing in stocks, are always the buy and hold long-term method, right? It's like opening up a Roth IRA, right? You're not expecting to cash in on that today. You're looking at down the line, like when your child gets older or you get older, whatever your retirement strategy, how much you're going to retire on. That's the purpose of investing in stock, right? Some people do it to get rich, and then you have short selling, which is the fourth way. One way to make money on stocks for which the price is falling is called short selling, which I mentioned earlier, or going short. Short selling is a fairly simple concept. An investor borrows a stock, sells the stock, then buys the stock back to return it to the lender. Short sellers are betting that the stock they sell will drop in price. Fifth thing is just contribute to your portfolio consistently. So a lot of jobs offer a 401k, so you can invest in that 401k, but even if you leave the company, it's good to still invest in that 401k, but it's a commitment because your 401k, it's a consistent price that you pay a month. Whatever it is you agree to, you have to stick to that. Normally they withdraw that from your check, and it's usually by a percentage. So some people may start off small, start off with what you can manage, maybe 4%, and then increase it, as you invest more, or you could start high and then reduce that amount as you go along. So anyway, that's it. Some of what I spoke about, I was inspired by ETF in versus index fund, which was written by a gentleman by the name of Chris Davis. So anyway, hope you like this video. Please share, comment, and subscribe to the channel. If you want to hear more on my real estate tips, or if you want to hear more on my personal development tips, or you want any coaching, that's it. And like this video again. Thank you.